All right, everyone. So today we're going to be talking about the balance sheet and financial disclosures. What I'm going to do is try to break up the lecture into, maybe like 30-minute segments or something like that. And so I'll try to keep track of the time as best I can and kind of do 30 minutes, kind of save that video and then do another 30 minutes. And hopefully this is pretty similar to what we do in class if you have me for class, or if you don't, hopefully you find, sort of a more condensed video, a little easier to follow. But in intermediate accounting, when you really start getting into the financial statements, it's still kind of a repeat of what most people have seen in a principles kind of a class. And so, if you had a discussion of the balance sheet in your principles class, some of this is going to be a repeat, but there's probably going to be some new pieces to it too, a little more detail. I'd say paying attention a little more to exactly the way things are presented and formatted, and almost certainly probably a little more on how we use the information on a balance sheet. And so anyways, so hopefully this is helpful, and we'll kind of jump into it. All right, so we talk about the balance sheet, of course, chapter 1 and chapter 2 in intermediate. At least we touch on them, not in a lot of detail, but at least some measure of discussion. And so obviously we're going to go a lot deeper here. One challenge in accounting is account names. There's really no way around it. You're going to have to know what accounts receivable is versus accounts payable versus unearned revenue. And then, of course, you do have all the income statement accounts as well. And you need to be able to distinguish between what goes on the balance sheet and what goes on the income statement, not just for this class, but just as a business professional. When you're having conversations, you should be aware that when someone's talking about the balance sheet, the types of accounts that they're talking about, you don't want to be confused or a little bit lost. And so it's a skill that you're going to need, whether you're an accountant, a finance person, or management, whatever it might be. And so what I would do is make sure that you go through the account names on a regular basis. Some students will use flashcards, nothing wrong with that. But there's lots of different things that you can use. So between the lectures, the book, and the homework, you're going to see a lot of different account names, and hopefully you kind of gather them all up and start to better understand all those different account names. All right, so let's kind of jump into the balance sheet here. First of all, I'm going to ask questions and sort of pause. And so I'll pause a little bit. At certain times, I may say, hey, pause the video and go look something up. And then I'll pause for maybe 5 seconds and then move on, knowing that some of you will actually take me up on the pause and some of you won't. But whenever I ask a question like this, what is another name for the balance sheet? I really do want you to think about it. And if you're not sure right away, pause the video and think about it and see if you can remember the name of that. And if you don't, you can look it up, or you can just, wait to hear me say it. But, I'm going to try to make this as interactive as possible without having painful pauses when there's really no one else on the other side of the screen as far as real time. So another name for the balance sheet. The answer is the statement of financial position. If you remember, when we looked at Target's 10K, they actually used that terminology. I think they call it, statement of financial position. And so that's another common name for the balance sheet, because it tells you sort of where you are at a point in time. And so that position, that financial position, kind of communicates that. Again, as we think about the balance sheet, there's a couple things we probably need to always keep in mind. We're kind of diving a little deeper here. First of all, what type of accounts? And the answer is, assets, liabilities, and permanent equity accounts. And if you remember from chapter 2, these are those permanent accounts, the ones that don't get closed. Other accounts like sales revenue, cost of goods sold, expenses, gains, losses, those are all temporary accounts, and dividends, those are all temporary accounts that get closed. None of those end up on the balance sheet. On the last test, I know some students mistakenly put some income statement items on the balance sheet, but hopefully, as we go through it this time, it'll be a little clearer. The second thing is, balance sheets are something that's reported at a particular point in time. And it's part of the regular financial reporting process. And so a lot of companies will create and prepare a balance sheet every month, every quarter, or at a minimum every year. If you are a publicly traded company, you have to prepare a balance sheet every quarter and every year. But internally, a lot of companies, or even private companies, will kind of give an update on their balance sheet every single month. And again, it's not an accumulation. Remember, it's not like sales revenue where it's okay, sales revenue for the month or for the year. It's really at this point in time, what is the balance in our cash? What is the balance in our receivables? What are our payables? And sort of looking at it at a point in time. And so you can kind of pull a balance sheet at any time, but typically it's going to be reported at the end of a period. All right, let's talk about the way a balance sheet is used. And there really are, two terms that are most often associated with what is communicated within the balance sheet. And the first one is liquidity. So liquidity, it's the measure of a firm, what is their ability to convert its assets into cash to meet its current obligations. And so, generally speaking, if you don't have sufficient assets that can be converted to cash, you're kind of in a liquidity crunch. In other words, cash needs to come from somewhere. Now, some companies are sort of operate that way, like Walmart is an example, where really they're always converting, their sales. So they might have inventory that's not even on their books, but they know they're going to bring inventory in the next 2 weeks that will be sold in the next 2 weeks and collected in the next 2 weeks. And so their turn is so fast that a lot of times they may not at any given point in time seem like they have sufficient liquidity, but it's part of their business model. And so whenever you think about liquidity, I want you to be thinking in context. It's always about context. And so, a company can be more liquid or less liquid, but it doesn't mean that it's better or worse. It just means more versus less liquid. It's just a business strategy where companies do vary on that. And then on the second one, and again, if you haven't paused it, you can now, but the second one is long-term solvency. So long-term solvency, this measure, rather than just looking at the most liquid or the most current obligations, it's really a broader picture. And so rather than just current liabilities, are they able to meet some of their long-term liabilities as well? Financial flexibility is another term that oftentimes we use in this context. In other words, if you're highly leveraged, General Motors was in this situation several years ago where, I think they actually had more debt than they had assets at one point in time. And what happens is that puts you in a position where your ability to adapt is very limited because you're just so leveraged and you have so many obligations out there that any resources that you have are kind of put primarily towards meeting those obligations. It's sort of like, a lot of college students when they take on credit card debt, if it gets too much, pretty much every dime they have just goes towards paying up, keeping up with their credit card payments. And all of a sudden now, if you need to buy books or you need to go do something else, you don't have the flexibility to go do that because you're so leveraged. You have, you're so insolvent at that point. And so, but again, I want to be clear that, solvency isn't about good or bad. It's about higher versus lower, more financially flexible versus less financially flexible. And sometimes there are reasons to take on debt as a company as part of your overall strategy. So I don't want you to think, debt is always bad. It's just a tool. And if you use it the right way, it can be very powerful in increasing your returns. But at the same time, the more debt you take on, the less liquid you're going to be. And the balance sheet is where we measure that. Okay. Balance sheet is not an end all. It's not an end all. So there are limitations. And the most noteworthy one is that when we kind of look at this book value, and I'm going to kind of try to use a highlighter here or a pen. See how good I am with it. But the biggest idea here is, when you have this book value, that is what is measured on the balance sheet. And that book value is oftentimes, and in fact, almost certainly isn't ever exactly the same thing as the market value or fair value. And so I want to be clear when we talk about market value or fair value, we're talking about a stock price. Now, obviously, we know stock prices for publicly traded companies, but private companies do have sort of what I call an inferred stock price or an inferred market value. And so, and even for those, the book value on the balance sheet and the market value that someone would assess to that firm, they're not the same thing. Most notably, the market value or fair value it's the present value of future cash flows or expected future cash flows. And so, when you think about that, there's this stream of income or the stream of cash flows that a company is likely to produce. And whenever you think about a book or a market value, it's how do I price that? What value do I place on that? And clearly that's not the same thing. It's just the sum of all its assets less the sum of all its liabilities, or whatever you want to talk about. And so that's sort of one idea, is they're just measured very differently. But there's also kind of practical things, and this is where there are two main reasons. And so pause it and think about why do you think, practically speaking, not just this discounted cash flow thing, but just other sort of practical reasons why the book value of a firm and the fair value of a firm really aren't the same thing. So go ahead and pause it here, and when you're ready, come back. Okay, so there are two main reasons. And so the first of those is, many assets are going to be measured at historical cost. So if I acquire a building or land, whatever I paid at the time, that's where it stays at my books. And even with a building, you're going to depreciate that. So eventually, on your books, your building may be worth zero, even though, as a practical matter, I mean, your building is never worth nothing. And think about this too. If you buy, say your company's 50 years old and you bought land, 50 years ago at the company's founding, well, the value of that land today versus the value of that land when you bought it are very different things. And so, that's sort of one very practical reason why, your book value, what's reported on the balance sheet, is not the same as the market value. And then the second thing, and this is probably more about the dividend discount sort of thing, which is when you talk about, there are resources that the firm has, and it might be, brand reputation or management expertise or other things, but all these things sort of lead to expectations. Another term that you might hear every once in a while is this term called goodwill. And that term is often meant to capture sort of the value of the business that's not directly on the balance sheet. Now, in accounting, goodwill has a very specific meaning, which is not quite that broad, but it is an idea of something that's sort of not on the balance sheet that maybe you could. And there have been times where people have pushed to try to put some sort of value, market value, on the balance sheet as an asset of the business, but I don't really see that happening anytime soon. All right, so now we're going to kind of talk about the different elements that we have. And so rather than sort of jump into it now, what I'm going to do is I'm going to sort of end this recording, and then we're going to pick this up with the next one, and we'll kind of do each one. So that's about almost a 15-minute session. And so I think that's a good time to stop. 15 minutes, probably a little better than half an hour.